Are you stressed out? Or better yet, is your portfolio stressed out? You know, when you take a look at 2020, we have done a lot of things, have been through a lot of things, and it's still not over. We're experiencing more market volatility. Maybe change is coming in any direction possible. Who knows what the next headlines is going to bring us? But your retirement still holds true, correct? You still want to do all the things that you have to do, but all the noise and mess around us sometimes stresses us out. But more importantly, is your portfolio stressed out? We're going to stress test your portfolio today, folks. Thank you so much for joining us. Show's called Your Money, Your Wealth. My name's Joey Anderson. I'm a certified financial planner, president of here, Pure Financial Advisors. And of course, this show is not the show without the big man, Big Al Clopine, still chilling in Hawaii. Aloha there, Mr. Clopine.
Hey, Joe, it's not very stressful here in Hawaii, but we do need to stress test our portfolios.
Here's the stats, folks. All of us. I mean, the numbers can't get much higher than this. 72% are worried that another recession or market downturn is going to blow up our overall retirement plans. 72%. Right? There's a lot of worry and a lot of stress out there. Then look at this statistic, almost 75%, right? One major health expense can completely break us, right? One major health expense. So what are you doing to make sure that if something happens in the overall market, that we do have a recession, or a loved one does get hurt, or it needs help or sick, is your overall plan going to be in place? Let's stress test your portfolio, folks. That's today's Financial Focus. You know, when you look at stress testing your portfolio, there's a lot of scenarios that you can run. Right? Is the market going to crash? Maybe you want to spend more money. Maybe you have a one-time expense. Or there's 100 different other categories that you can kind of put in and try to break your plan. I don't want Al to break the show, but let's bring him in to break everything down for us. Big Al?
So today we're going to talk about stress testing your retirement plan, because it may look pretty good as is, but what happens if things go wrong? And we don't like to think about that, but it's better to think about it and have a plan. So how we do that is we start with looking at your baseline, looking at where you're at right now. Kind of if all things go according to plan, that's kind of your starting point. Then stress testing the retirement plan to see how it looks, how it performs when different events happen, such as a market decline. When you do the stress test, you can assess your weaknesses. And then, of course, when you know what your weaknesses are, you can work on making it better, improving your financial fitness. And Joe, I think this is an important topic. I mean, we've had a long bull market for quite some time, and at some point there's going to be a recession. We don't know when. It could be soon, it could be in a while, but people need to be thinking about it and be prepared for it.
Well, I mean, we're living in a crazy time, right? We're going to see a lot of volatility in the overall markets for quite some time, I believe. But it's the stress test is not only the markets, it's the investor's behavior. How much money are you actually spending, and can you continue to spend what you're spending? Can you spend a little bit more? So it's not all bad. If you've ever had a stress test, I mean, just the title of it, it's like, let me turn the channel. I mean, I don't want to stress test anything. But it's important to make sure that you take a look to see, all right, if the strategies that you put together before are still in line, that the portfolio can still do it. Is the tax law changed? Is your lives changed? So this is really important to kind of take a look and start with that baseline. And I think, Al, you're right on. It's like, what are you doing now? Is this going to continue to carry you through? Then if so, by all means, you've done your job. But if not, what are some things that they should be looking at?
So if you think about what your retirement baseline looks like, it doesn't have to be that complicated. So look at our example. Retirement spending here, either current or desired, $90,000, and you subtract out fixed income. In this case, it's only Social Security. Let's say that's $40,000. Very simple example. Shortfall's $50,000. So that's what you need from your portfolio each and every year. You look at your portfolio, in this case it's $1 million, all right? So you divide the shortfall into the retirement assets and you get 5%. That's what's known as your distribution rate. Now, generally, we like to see that distribution rate 4% or lower. A 5% rate, Joe, sometimes, depending upon what the market does or depending upon what life throws at you, could be a little bit high.
Yeah, without question. I mean, you have to look at, all right, well, are you 5%, 6%, or is it 3%? This is just a rule of thumb. Right, Bill Bingen, he's right here in San Diego in our backyard, came up with the 4% rule years and years ago. Other experts now, they're looking at maybe 3%. So it's not a golden rule. So, hey, I have $1 million and I don't want to pull out any more than 4 because some years you're going to pull out higher and some years you're going to pull out a lot less. It's a rule of thumb. But what happens, Al, is that life gets in the way or the markets will turn volatile on you. A volatile stock market is your best friend as I'm saving money. It's called dollar cost averaging, right? So I have a share of stock at $10 a share, but then if it drops to $5, if I'm still saving that, let's say $100 a month into my 401k plan, guess what? I just bought 2 shares, right? So I'm buying more shares when the market goes down as I'm saving money. As I take dollars out of the overall portfolio in a down market, it could be the biggest disaster. It only could be like a slight dip too. It's all about timing in some instances. Because if you lose 50% of your portfolio, hypothetically of course, and you gain 50% the next year, you don't have your money back. Right? If I lose 50% of the portfolio, you need 100% just to get your money back. And if you're taking dollars out to live off of, right, you're gonna go broke. The money will run out. So that's why having this stress test done on your portfolio is key in understanding the difference between saving money and spending, and especially in a volatile market as you're trying to create income. Because the sequence of return risk, Al, is everything. Right? It doesn't matter what you average long term, but what return hits your account when you're taking dollars out.
That's absolutely right, Joe. And so we've got an example to kind of explain the sequence of return risk, if you will. And this would be that same portfolio we just looked at. So you've got $1 million and you're pulling out $50,000 a year. Let's assume a 3% inflation rate. Okay, so in this example, essentially we have 2 different scenarios, and in both cases you're generally earning about 7.5%. But in each case, you have 3 years that are lower. You have 1 year that's minus 10%, 1 year that's 5%, 1 year that's flat, 0. So in the first example, the lower markets are right up front, and in the second example, the lower markets are at the end of this 30-year period. And if you look at what happens to the results, and it's not too much of a mystery, if you have a poor market when you first retire, it puts a lot more stress on your portfolio. And in this very simple example, you run out of money right after year 20, right? And in the second example, where you're chugging along with a 7.5% return, and you just have a couple bad years at the end, then you still have plenty of money. Now, of course, Joe, in reality, this never happens. It bounces all over the place, but it just illustrates why the rate of return, how it's going to potentially affect your portfolio.
Right. I guess maybe a better example would have been, some years you're getting 7%, 8%, 12%, the negative 10%, and so on. And then over that time period, let's say you average 7.5% over a 25-year time period. Right. And then the other one has rates of return all over the place too. But you have a bear market, closer to your retirement date versus a bull market. If you have a bear market closer to your retirement date, and then you start taking dollars out and you're taking monies out, of your portfolio in a down market in the beginning, as you can see on the chart, the yellow, right? That's a bear market in the beginning of your retirement, and the blue is a bull market in the beginning of your retirement. So it's the sequence of return. So this is why, just stress testing it. If the markets drop 20, 30%, what's my plan? What's my strategy? Do I have to revise my plan? And I think a lot of people don't necessarily do that. That's good and bad though, right? We don't want you to be changing strategy every single year. I mean, that would be a disaster. But find the right strategy and then understand what plan A, plan B, plan C is going to be, and then when do you implement those subset plans? Because most people will have to revise their plan or it's going to catch up to them.
So if you look at our first example, we've revised it a little bit. Maybe spending is reduced just a little bit, maybe about $5,000. So now we're spending $85,000, and we were able either to delay Social Security to get more income or work part-time or maybe a combination. So now we have more fixed income. Now the shortfall is $35,000, and now our distribution rate is 3.5%. Again, it's no guarantee, but this is a much more likely scenario to succeed in almost all types of markets and almost all types of situations.
Yeah, without question, it's looking at, all right, well, what tweaks do you have to make, and then making sure that you're tweaking with it. So here's the special offer this week, which I hope a lot of you take advantage of. We're going to stress test your overall game plan. Right here at Your Money, Your Wealth. All you got to do is go to yourmoneyyourwealth.com, click on that special offer, and if you want our help just to stress test it, take a look, hey, given certain scenarios, if the market drops, if the market goes up, how much money are you spending? How much can you continue to spend? What are some different ideas to make your money stretch a little bit further? Are you in the right portfolio or are you in the wrong portfolio given what your goals are? What is the tax situation? Is there some ideas that we can do around that? So take advantage of this. It's all yours for free. There's nothing could go wrong, right? If you stress test it, go to yourmoneyyourwealth.com, click on that special offer, get in before the end of the year, and we will make it happen for you. All right, we got to take another break, or we got to take our first break. We're just getting started here, folks. We'll be back in just a second. Show's called Your Money, Your Wealth. Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson, Big Al, Clopine. We're talking about stress testing your overall retirement plan. Have you stress tested your retirement plan? We give you the opportunity right here at Your Money, Your Wealth. Go to yourmoneyyourwealth.com, click on that special offer to get the stress test that you've always wanted. Let me tell you, this stress test is no stress whatsoever. We got Kyle Stacy joining me this segment. I'm very excited to talk to Kyle Stacy. He's a certified financial planner here at Pure Financial Advisors. But before we get to Kyle, Al, let's go to the true-false question.
If I play it safe and invest in bonds and other low-risk investments, I won't have to worry about the impact of volatile markets on my portfolio. Well, I would say that's true, but you've got other worries. You're probably not going to keep up with the market, with inflation. Perhaps you may not have enough rate of return to accomplish your goals, to live the life you want. So just be careful of that.
Yeah, without question, Al. If you kind of run for the hills and get scared, right, that's probably not great. So, but you know what? Let's bring in Kyle Stacy to walk us through some of the things that you might want to consider when you stress test your retirement. Kyle, welcome.
Thanks for having me.
Yes, we're talking about stress testing portfolios, okay? And so let's talk about some things that maybe people can be doing. When you think of stress tests, it's like, well, I don't know, yeah, when bad things happen. But let's get into specifics, right? When you're working with clients and things like that, it's what are some of the things that they should be considering if they're trying to stress test their portfolios, if you will, at home?
It's when, right? It's not necessarily if this happens, what if this, it's when. So it's what can you do to prepare for that, right? So I think, we'll talk about a couple of things here is, assuming 20% retirement investment decline, right? That's going to happen at some point. The portfolio will drop in value. This is where bonds are really important, right? As you accumulate wealth, you might not be holding them, but as you make that transition, capital preservation is really important. So it's important to have some fixed income to make sure that when the portfolio does fall, you've got maybe 3 to 4 years of distributions that you can pull from those bonds so that you don't have to worry about what stocks are doing.
Maybe people don't really realize how much maybe their portfolio is subject to risk.
Right. I mean, right. You put 20% to it, right? Put it in dollar values, right? You got $1 million, 20% might not mean that much, but when you say $200,000, I mean, that's the price of a house, right?
Right. Or if they have 100% equities, if the market drops 20%, but if they only have 50% equities, then that's a huge difference. So if you look at a stress test of a portfolio that is maybe 80, 90, 100% equities versus 40 or 50%, the 40 or 50% equities is going to hold true. Right? It's not going to take that much time to recover. And sometimes I don't think people really look at their portfolios to kind of see, how much stock exposure do I have? Because I started a long time ago, I'm saving money into the thing, and then you see it go up, and I've never rebalanced. What about living expenses?
Most people want to spend more money in retirement, right? You don't want to have to go and penny pinch in retirement. So it's like, well, if you retire early, if you're forced into an early retirement, you might have some other expenditures you might have to pay for, like healthcare, insurance. Right, you might need a new vehicle, anything, right? So things tend to get more expensive as you get a little bit older. So it's just making sure you've got a plan in place for those things.
Looking at one-time expenses, what are examples of that?
Right. Most people over time, you're going to have some big purchase ticket items, right? You might buy a car. You might want to take that vacation to Greece, right, overseas that you've never been able to do before. But you got to be flexible too, right? I mean, if you head into COVID, one, you can't go anywhere anyway, all right? So then maybe you got to push that out a year, maybe 2 years. Make sure you've got, as you guys talk about, emergency funds, make sure that it's built up for that purpose specifically.
There's a statistic out there that looks at, all right, well, 50% of us are going to be forced into retirement. You look at, all right, well, when do you plan on retiring? People say, well, I'm going to retire at 67 or even 70 years old. Right? But the average age of retirement today is still like 63. So even though you're trying to look or you're planning for a later retirement, we still might get forced into an early retirement.
Yeah, absolutely. I think you nailed it right on the head. It's like so many people say, 65 and older is when I want to retire. But at the same time, things happen with the markets and COVID and everything. People are forced into retirement. They don't have the income coming in. They got to pay for things out of pocket now. So expenses go up, right? Markets are going down. They're crazy. So it's really important to make sure you have a plan in place. Again, God forbid something happens.
This has been great. Thank you, Kyle. When you look at stress testing your portfolio, these are just some ideas, right? Hey, if your retirement account drops 20% or even 30%, what does that really mean to you? If the market implodes, right? You're going to see volatility over the long term, but what happens there? You want to increase your living expenses. I don't know, start by 5%, go to 15%, go to 50% for all I care, right? Then you can see how much that you actually can spend. What is the max spending amount? Do you even know that? How about if you have like one-time huge medical expense, right? Or maybe you just want to blow the load and say, hey, whole family, let's go on a cruise, right? All sorts of different things that you can do. We can help you with this with our stress test. Go to yourmoneyyourwealth.com, click on that special offer, and we will help you stress test your overall portfolio. Go to yourmoneyyourwealth.com, and we will do that for you at no charge whatsoever. We're going to take another break. When we get back, we're going to wrap up the show, bring Big Al back, and answer true, false, and do all sorts of fun stuff. Kyle Stacy, CFP, thank you, my friend.
Appreciate it.
All right, and we'll be back in just a second. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner with Big Al Clopine. Aloha, Big Al.
Aloha, Joseph. It's great to be here.
All right. Well, it's great to have you. Let's see how you did on the true false question.
It's best to stop contributing to my employer retirement plan during recession and wait until the market recovers. That's definitely false. But a lot of people do that. Joe, I mean, a lot of people want to stop investing when the market's down because they think investments don't work. If you kind of chart your life of a saving and investing, that's actually the best time to invest because the market's down. You're buying stocks on sale.
The problem is that you're saving money, right? You see your paycheck, it's going down because you're going into the 401k plan. Then you look at your 401k plan statement, and it was $250,000. Now it's $225,000, but you just put in $5,000. It's like, well, what the heck? And then, the next couple of months go by, you put in another $5,000, you look at your statement, now it's $200,000. And so it's like, why am I throwing really good money after bad? I got to stop doing this, right? And I get it. It totally makes sense. You don't want to lose money. No one wants to lose money. But no one really equates it to, oh, look at how many more shares that I bought, because your statement usually doesn't show that. So looking at improving your financial fitness, there's a few little nuggets here that we can share.
Yeah, I think so. And I think these ideas kind of help everybody. So we'll start with, some of these are kind of basic, maybe a review, but create an emergency fund. Hopefully you have one, right? How much should you have? Well, a lot of financial planners say 3 to 6 months. Many people that are retired like to have a year in cash. It kind of depends on your comfort level for cash and safety. It also depends upon the security of your fixed income.
It's making sure that you have that safety net, right? And so then it's reducing spending in down markets. And some people might have to create additional income. What does that mean? All right, well, maybe I'm working overtime, working part-time, getting a side gig, whatever it takes, right? No one likes to do any of this stuff. Who wants to reduce spending and go back to work? But you got to do what you got to do, right, to make sure that you can take care of your older self down the road. Or maybe you look at, all right, well, let's just plan appropriately. Is your portfolio, is your strategy in line with what you're trying to accomplish? And if you don't necessarily want to spend less or go back to work, then I encourage you to kind of stress test it to see what it can handle. Because of course we got to invest for the long term. You're not investing, year by year by year. You have to look at this long term. I know it's hard to look at the long term, right? Especially when markets are volatile, but you have to, right? Make sure that you're globally diversified, and then don't panic. I don't know about the taking care of your health, Al.
Well, that's the idea there is that if you're taking care of your health, you won't have as many medical bills and you'll be able to stretch your money further. So that's the idea there.
I'm going to do the opposite. Right?
You're just going to eat and drink and smoke and whatever you want to do.
Just blow it out. Just have fun.
Because then you'll shorten your life expectancy. You won't need so much money.
That's it, brother.
That is the way to go.
It's the best. That sounds like.
And then I guess finally, don't panic. That's easier said than done. But when times are hard, people tend to panic, and try not to. There are a lot of strategies, whether it's meditation or more sleep or exercise or yoga. You ever tried yoga, Joe?
Alan, I'm 6'4". and 200.
I would like to see that. Or actually,
pounds.
maybe I don't want to see that.
All right, let's go to ask the experts.
I'm concerned the market is overvalued and I want to sell my highest value tech stocks now. I'm not retiring for another 3 or 4 years. Do I invest in stocks when the prices come down or invest in something less risky now? Laura from Mira Mesa. So in this particular case, it sounds like you have individual securities. You may want to take some gains off the table. I mean, that's the idea, rebalancing, taking some gains off the table. But I don't really like the idea of selling and going to cash. That's market timing, and that tends to not work that well over the long term.
Yeah, but okay, so just the statement itself, it was worrisome a little bit. All right, I believe that the stock market is overvalued. Well, how do you know what's overvalued or undervalued? That type of thinking sometimes gets us into trouble. It's like, well, I think it's it's going to pull back at some point. And like Al said, that's timing the overall markets. Oh, and then I'm going to sell some tech stocks, and then what? Are you going to buy textiles? Right? So that to me doesn't really sound like a game plan or investing. It sounds more like gambling. Is that I have a gut feeling that the market's overvalued. You don't know when the market is truly overvalued. We've seen price to earnings ratios pretty high, right? That kept on going higher, right? So there's not a strict definition. So just kind of be careful with that. But if you are heavily weighted in one area of the overall market, then yes, of course, you probably want to be a little bit more diversified. Al, let's go to Greg.
I'm deciding whether to buy a condo and have my son as a renter so it cash flows, or just putting money into the stock market. Which investment generally gets a better rate of return just from a numbers standpoint? Well, it depends. It depends on a lot of things. I've invested in both for a long time, so I'll just tell you very quickly. Real estate used when you borrow money to buy real estate with leverage. If you buy the right property, have it rented, blah, 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 you can actually do better than the stock market. But it's a lot of work too, right? And there's a lot of things that can go wrong to make it way worse than a stock investment. So, Joe, it just depends.
No, without question, right? There's certain stocks that are going to outperform other types of stocks. There's certain asset classes that are going to outperform other asset classes. You want to be diversified, buy the condo or put the money into the market? Well, it really depends on what condo that you're buying and what area. Right? What interest rate that you're going to get on the loan? Do you hold a loan? Are you going to have it rented full time? Are you going to be the property manager or not? I don't know. Have you ever done it before? Markets could go bad. All of a sudden rents, there's all sorts of risks, I think, in both areas. So, hey, what did we learn? What did we learn today? We learned that I'm not going to be healthy if I'm running out of money. That's what I learned. Run a retirement baseline, right? Just figure out what the heck is going on. Are you on the right path? and then explore the extremes. If the market drops 50%, if it's up 50%, 20, 30, whatever. Just start trying to break your plan as much as you can, right? What's really going to make this thing snap, and do the things that you don't want to do. And then you can make adjustments or have that plan B or contingency plans that will help you put into place when things kind of go awry. So the smartest laid out plan could be a disaster if you don't have a contingency plan. We're here to help you take advantage of our stress test. Go to yourmoneyyourwealth.com, click on that special offer. It is a in-person, in Zoom stress test. We'll take a look at your current situation to see what's good, see what's bad, see what's ugly, and making sure that we'll try to break it as much as we can. Put a long-term care stay, a lot of health issues, right? Great health, you're living forever, right? Markets go up and down, increase huge taxes. Let's say taxes go up another 30%. What does that do? We will help you with all of that. Just go to the stress test button. It's under special offer under yourmoneyyourwealth.com. Want to thank you again very much for joining us. Hopefully you enjoyed the show as much as we did. For Big Al Clopine, I'm Joe Anderson. We'll see you again here all next week, folks. Aloha.
Aloha.